Artificial intelligence just leveled up from answering questions to actually taking action. And that tiny shift just forced the world's most important chipmaker to max out its capital spending at $56 billion this year. Welcome to Earnings Unscripted. It is April 16th, 2026. We are unpacking TSMC, ticker TSM, and their first quarter results. So they basically crushed the estimates, right?
Yeah, they didn't just crush them. They essentially absorbed the entire industry. I mean, revenue was $35.9 billion US dollars, up over 6% sequentially. Earnings came in at $3.49 per ADR, up over 13% from Q4. But the real story isn't the top line. It's the internal mix.
Right. And before we dig into that mix, I should probably mention that Miro and I are just thinking out loud here. This is not financial advice, so please do not base your trades on our caffeine-fueled spreadsheet theories. But yes, the mix. You are talking about the high-performance computing segment.
Exactly. HPC grew 20% in 3 months. It is now sitting at a massive 61% of their total wafer revenue. So the smartphone is, well, it is officially dethroned as the king of silicon.
May it rest in peace. Okay, but if HPC is dragging the whole ship forward like that, how did margins do? Because they guided pretty conservatively last time.
They did. They pointed to maybe 65% tops. They actually delivered a gross margin of 66.2. That is up almost 4 full percentage points from last quarter. Operating margin also surged to 58.1%. It is just staggering operational leverage right now.
Geez, but wait, if they printed near 60% operating margins, what was going on with the tape today? Because the stock saw this really sharp pre-market sell-off down to around 362 before it managed to claw back and close almost totally flat near 368. Somebody clearly panicked early on.
They did. Investors are looking at raw material inflation out of the Middle East, plus all this external noise about big tech customers building their own custom chips to avoid TSMC. But C.C. Wei actually addressed that head on. He basically told these impatient billionaires that you cannot speedrun physics. He bluntly reminded everyone it takes up to 5 years to build and ramp a fab. Quote, no shortcuts.
That is incredible. You can have infinite capital, but you still have to wait in the physics line. I love that. All right, let's get into the details on where exactly that $56 billion in CapEx is going.
So it is going straight into the token furnace, literally, because the whole architecture of AI demand is shifting under our feet right now.
What do you mean by architecture? Like the models themselves?
Right. We are moving from, well, basic generative AI to what C.C. Wei called Agentic AI. Think about it. You ask a chatbot for a recipe, that is query mode. It uses a set amount of compute. But if you tell an AI to go online, order those ingredients, track the delivery, and adjust your weekly budget, that is action mode. It is running continuous loops.
Oh, okay. So it's not just retrieving text anymore. It's actually acting on your behalf in the background, which I guess burns a lot more computing power.
A massive amount more. Wei was very explicit about this on the call. I have the quote right here. He said, the shift from generative AI and the query mode to agentic AI and the command and the action mode is leading to another step up in the amount of tokens being consumed. So they are basically being forced to build to the top end of that $56 billion range just to keep up with the burn rate.
Jeez. And you really cannot overstate how wild that number is. I mean, they're essentially building an entire Fortune 500 company's worth of physical infrastructure every single year.
Every 12 months.
Yeah. And you can actually see them aggressively pulling that infrastructure forward if you dig into the balance sheet. I mean, their current liabilities jumped by over 256 billion new Taiwan dollars sequentially.
Wait, just from Q4 to Q1? That's not a normal seasonal tick.
No, it's a land grab.
Roughly half of that spike is accrued liabilities, and another huge chunk is accounts payable. They're basically vacuuming up equipment and materials from their supply chain before anyone else can get to them. They even pushed their inventory up to 80 days. That's 6 days higher than last quarter.
Okay, but packing warehouses like that, it actually contradicts the whole supply constraint narrative. Why tie up all that cash in inventory if you can sell everything you make?
Management claims it's strictly for the upcoming 2-nanometer ramp and some heavy 3-nanometer demand. But honestly, it feels like geopolitical insurance. Because of the Middle East warnings they gave.
Exactly. The CFO explicitly flagged that prices for key foundry chemicals and specialty gases, things like helium and hydrogen, are very likely going up because of the conflict. So building up 6 extra days of safety stock is basically a hedge against input inflation.
Right. Which they are going to need, especially when you look at their margins from a global footprint perspective, because I noticed Wendell Huang had some really sobering commentary about building outside of Taiwan.
He did. The market loves the idea of decentralizing chip production. Building in Arizona, Germany, Japan, it sounds great for supply security. But Huang put hard numbers on the cost. He guided that these overseas fabs will dilute overall gross margins by 2 to 3% early on, and then, this is the kicker, widen to 3 to 4% in the later stages.
Widen to 4%? Usually when you scale up a new factory, things get cheaper. You figure out the kinks and the margins improve.
Right, except in this case, they are admitting a very painful structural reality. Fabricating a chip in the US or Europe is just permanently more expensive. The labor, the fragmented supply chains, the overhead, it never reaches parity with Taiwan. That 3 to 4% penalty is not a temporary launch cost. It is a permanent globalization tax.
Wow. So essentially, Western politicians get the headline about bringing chips home, but TSMC shareholders absorb a permanent multi-billion-dollar haircut to make it happen?
Basically. And to absorb that hit, they desperately need their newest nodes to be wildly profitable, which, thankfully for them, the CFO confirmed that 3-nanometer gross margins are finally going to cross above the corporate average in the second half of this year.
Just in time for the 2-nanometer launch to bring its own dilution penalty. It feels like they are constantly outrunning their own costs.
Yep, they are running a thermal budget at redline, essentially.
Perfect way to put it. So balancing a permanent overseas tax against this massive agentic AI scale-up, that is quite a tightrope. So where does this actually leave them heading into next quarter and the rest of 2026?
It leaves them sprinting, honestly. I mean, they are guiding Q2 revenue somewhere between 39 and 40.2 billion US dollars, which is, roughly another 10% sequential jump. And they expect those gross margins to push even higher, maybe hitting 67.5% at the top end.
Wow. So they just keep breaking their own ceilings. But I think the crazy part is the full year, right? They're projecting total revenue to grow above 30%. That requires some serious, deep faith that this whole agentic AI transition actually holds up.
Yeah, exactly. And C.C. Wei essentially said their conviction in the multi-year AI megatrend remains high. They really do not view this as a temporary spike. I mean, they're already laying out the specs for A14, which is their 1.4 nanometer equivalent, scheduled for 2028. So they're locking in a defense line 4 years out.
Which is just wild to think about. We're sitting here worrying about Q2 inflation, and they're doing math for 2028. So for the immediate future, what is the one thing we need to watch next quarter? Just to see if those material costs actually start biting?
Pretty much. I mean, the operating leverage is doing a massive amount of work right now. But those overseas fab penalties, plus the Middle East supply issues with gases and chemicals, that is a real permanent gravity well. So the main thing to watch is simply whether they can outrun their own structural costs.
It is kind of an incredible story, though. It's basically an entire industry betting that the physical world can keep up with the software world.
Yeah, it's brilliant execution, but they're playing a very, very expensive game of physics.
A $56 billion game, I guess.
Fair enough.
All right, well, I think that wraps up TSMC's wild ride for this quarter. Thanks for geeking out with me, Miro.
We'll see you next time.
Bye, everyone.
And hey, if you want these teardowns to just quietly show up in your app whenever earnings drop, you can always give the show a follow.
which, by the way, is an experiment built with AI tools to help us turn these massive SEC filings into actual listenable conversations. If you have a ticker you want us to untangle next, just send it over to earningsunscripted@datamadness.ca, or you can grab the X link down in the show notes.
Catch you on the next one.